Quantitative tightening begins. Could this crash the housing market? University of Michigan consumer sentiment for home purchases is the lowest in decades. Redfin CEO says sellers are starting to freak out as market shifts. Hello, ladies and gentlemen. I hope you're all doing well. Welcome to the channel. Today we're going to cover the Fed's quantitative tightening and its effects on housing, as well as a recent interview with Glenn Kelman, CEO of Redfin. There's so much information to unpack here. Thank you so much for tuning in. One caveat, I'm a Florida, Georgia real estate broker, not a financial advisor. All right, let's begin. The Federal Reserve's almost $9 trillion portfolio is about to be reduced starting on Wednesday, combined with aggressive rate hikes in order to contain inflation. What will the consequences be for housing? So what's quantitative tightening? Quantitative tightening, or QT, increases the cost of borrowing in the form of higher interest rates for companies and consumers. This reduces the ability for firms to invest and consumers are less likely to spend. It can weaken confidence and trigger an asset slump, i.e. housing and stocks. However, the true effects are experimental and unknown. Mortgage rates will rise, putting further downward pressure on the housing market. As bonds mature on the Federal Reserve Bank's balance sheet, the capital is paid back by the issuer, i.e. the U.S. Treasury, government, or commercial banks. The cash received will be canceled, drained out of the system, shrinking the Federal Reserve's balance sheet. The result is no further bond sales to the Federal Reserve Bank, less spare liquidity, and fewer asset purchases. As rates rise and stimulus is withdrawn, weak firms that relied on low-cost borrowing may go bust. Maxed-out consumers could follow. Quantitative tightening leads to deflation. Housing prices could get hit. And stock market prices could collapse as confidence erodes, essentially draining liquidity from the markets. This could lead to a tapering tantrum like we saw in 2018. However, the Fed would have no choice as it reins in on inflation, bringing the economy into a recession. It will be far from watching paint dry, as Janet Yellen said in 2017. Could this lead to a housing crash? Let's review an article from MarketWatch. The Federal Reserve's almost $9 trillion asset portfolio is set to be reduced starting on Wednesday in a process intended to supplement rate hikes and buttress the central bank's fight against inflation. While the precise impact of quantitative tightening in financial markets is still up for debate, analysts at the Wells Fargo Investment Institute and Capital Economics agree that it's likely to produce another headwind for stocks. And that's a dilemma for investors facing multiple risks for their portfolio at the moment, as government bonds sold off and stocks nursed losses on Tuesday. In a nutshell, quantitative tightening is the opposite of quantitative easing. It's basically a way to reduce the money supply floating around the economy, and some say helps augment rate hikes in a predictable manner, though by how much remains unclear. And it may turn out to be anything but as dull as watching paint dry, as Janet Yellen described it when she was Fed chair in 2017, the last time when the central banks initiated a similar process. QT's main impact is in the financial markets. It's seen as likely to drive up real or inflation-adjusted yields, which in turn makes stocks somewhat less attractive, and it should put upward pressure on Treasury term premia, or compensation investors need for bearing interest rate risks over the life of a bond. University of Michigan consumer sentiment, bad time to buy a house. It was the lowest in decades at 45 on the index. Redfin CEO says sellers are starting to freak out as market shifts. Housing prices will soften in coming months, Glenn Kelman told CNBC. The housing market has been the record-shattering domain of sellers since the start of the pandemic, but Redfin CEO Glenn Kelman believes a shift is coming. Kelman told CNBC's Closing Bell the housing market will look relatively similar to now in 6 months. He did have an encouraging prediction for buyers, though. Rates are probably 6%, inventories are increasing, sales volume will be somewhat fine, but prices are going to soften, Kelman said. Softening prices would be a big deal for potential buyers who have contended with rising costs of purchasing a home for months. The S&P CoreLogic Case-Shiller Index in February posted a 19.8% annual gain, the third largest reading in 35 years. Kelman said a market pinch was coming due in part to rising mortgage rates that shot up from historic lows in the wake of the pandemic. Homeowners locked into lower mortgage rates likely wouldn't be inclined to pay both higher prices and higher rates for their next homes, which could signal a retreat in the market. And it goes on to say, buyers are saying I've had enough and sellers are starting to freak out a little bit, Kelman said. Kelman pointed to the secondary markets where sellers would be most inclined to freak out as prices start to take a step back, including Tacoma, Washington, and Sacramento, as well as a more affordable market in Sarasota, Florida. So, secondary markets are softening and could see price declines. In addition, aggressive interest rate hikes and quantitative tightening could intensely shock the market. Could this lead to a housing crash? Do you agree with the University of Michigan survey? Do you think it's a bad time to buy a home? Let us know in the comments. Okay, so today's takeaway. Quantitative tightening, or QT, will increase the cost of borrowing in the form of higher interest rates for companies and consumers. This will reduce the ability for firms to invest and consumers are less likely to spend. Quantitative tightening could potentially lead to deflation. housing prices could get hit, and stock market prices could collapse as confidence erodes, essentially draining liquidity out of the markets. University of Michigan's consumer sentiment bad time to buy a house was the lowest in decades at 45 on the index. Secondary housing markets are softening and could see price declines. Higher mortgage rates have an inverse relationship with housing prices. As rates rise and stimulus is withdrawn, the housing market, which relies on low-cost borrowing, may be the prick that pops the bubble, causing a massive housing crash. If you like this video, please consider subscribing to the channel and hit that like button. I'm a Florida, Georgia real estate broker, not a financial advisor. Thanks again. We'll see you in the next video.